Good evening, everyone, and welcome to episode 81 of SCOTONOMICS. Thanks so much for joining us this evening. Hello to our viewers on YouTube, Facebook, Twitter, and also on TikTok. We've got a really interesting session tonight. Kieran and I recorded this interview with a chap from IPPR called Simone on Friday. It's a brilliant discussion around the idea of a national investment fund from the UK. Now, that's quite a narrow topic, but we covered loads of different areas within the Scottish and the British economy. We discussed things like degrowth. We also covered the idea of where money comes from, how this fund would be capitalised, the role of the Scottish National Investment Bank. We covered lots of things in this interview. It's a really, really good interview. Simone's Italian, and we covered a little bit about the Italian economy as well. So there's loads in here. We're going to get straight into it. I'll be back at the end to answer any of your questions and go through the comments. I'll also do that if you drop them in while we're playing the video. So I really hope you enjoy this. It's about 45 minutes, so we will be back for a couple of minutes at the end of this. Enjoy it, and I'll speak to you soon.
Hi, Simone Gasperin. We're really pleased to have you on the show. I'd like you to tell our listeners a little bit about your background and the research, who you're doing it for, and what the research is about, please.
Thank you for inviting me to your show. I'm an economist by training, and I've got a PhD in innovation and public policy from UCL. I worked with Mariana Mozzacato in the past 4 or 5 years, and I had a 1 year government experience. Worked with the Italian government during the COVID period, the first phase of the COVID period. And now I've joined IPPR as an associate fellow, and I've worked in the past month on this project which is targeted to a proposal for a national investment fund for the UK.
Well, Simone, before we delve into the specifics and around your proposal for the UK, would you like to give us a general idea of what other blocs and countries have been doing, say, since the COVID period to kind of encourage investment in green infrastructure?
Yes, absolutely. So many sources, including some mainstream sources in both, I think, media and economic debate, are talking about the return of industrial policy. There is a much talk about that, and there is also a bit of theorization. But what we are seeing is definitely a change, a radical change compared to the pre-financial crisis period, at least. Even in Western countries, so even in the EU and in UK. Well, the UK we'll see, but in the US for sure. What's the aim of industrial policy? I mean, why are we back with this dirty word? It's basically the realization that to a certain extent, unfettered globalization hasn't really worked, and countries have shown their weaknesses when confronted to crises such as the financial crisis, the COVID crisis, and now the energy crisis. So now there is a lot of talk about strategic autonomy, supply chain security, and things like that. And the only way to achieve these two objectives, energy security, supply chain security, strategic autonomy on certain technologies, is to try to build domestic capacity in certain areas and certain manufacturing technologies and so on. And we've seen that with the especially in the East Asian countries, they've been doing that for ages, and China became the major powerhouse as it is now, thanks to massive industrial policy programs. But the surprising thing is that now, with the Biden administration, we've seen a series of legislation which were passed, which really innovated the way in which the state intervened. So we've seen the Infrastructure and Investment and Jobs Act, the Chips and Science Act, and the Inflation Reduction Act. Some people are estimating that these programs will amount to more than $2 trillion in the next 10 years. And to a certain extent, the European Union is responding in kind, although with much less financial resources, and each country is going in its own way. But recently, the European Union has launched the Green Deal Industrial Plan, which focuses on investing in key manufacturing industries and using different various policies, regulatory, but also some state funding. So we are living in a new scenario, and it seems like, and here we come to the UK question. It seems like that the UK is a bit lagging behind these recent developments.
If the UK is catching up, why do you think we've been slower to decide that this is something that's really important than the other Western countries?
There could be many explanations for that, but I think a major point is that we also outlined in the report is that the UK economic specialization model in the past, since Thatcher really, has been focused on financial services, not exclusively, but the idea was that the UK didn't need to be a major manufacturing country anymore, so we could let various industry go fail, and the UK could just focus on financial services. And the thing is, for a certain period, it was the financial sector of the City of London were a major source of government revenues, jobs, but it created many distortions, regional distortions, first of all, concentration of wealth and income in the southeast and in London in particular, but also distortions in terms of incentives. So once the financial sector becomes more profitable, but also more appealing to new graduates to work with, the brilliant minds of the country, they tend to go work for the hedge funds and investment banking instead. To go back to your example of the East Asian countries. In East Asian countries, they're really keen on training engineers. So I would say the focus on an economic model and an economic specialization that didn't consider the importance of manufacturing technologies and R&D research and things and all the related elements.
Tell us the basics. How would the fund work?
Basically, the fund is aimed at inverting this the tendency, the trend that I was talking about before. So to not just by itself, but contribute to the reindustrialization of the UK economy, meaning reindustrialization focusing on the manufacturing sector. So it's a public finance. It could be a public financing instrument to reshore productive capacity in the UK. For these reasons, it focuses again, as I said, on manufacturing. It uses equity instruments, equity financing, which is we might discuss it later. We argue it's more strategic than simple loan financing or other instruments such as state grants. And it has, and this is critical, an industrial policy aim. So contrary to other public financing instruments that have been set up in the UK recently and elsewhere in Europe, it really tries to do what, like economists say, to force comparative advantages, to go against market signals, because there is plenty of private capital that is willing to invest in activities that provide a safe financial return. Western economies don't need additional public instruments in this respect. They need instruments that can tweak the price system, and they can invest in areas that are promising, that areas that, as economists say, they provide dynamic increase in returns in the medium and long term. So the National Investment Fund, the way in which we conceived it, would be initially capitalized by a transfer from the government. So we said, I mean, we didn't put a figure there, but because we concentrated on the structure and the governance, but we said that it could be granted a transfer, a capital endowment from the Treasury, or it could, or its initial capital endowment could come from funding already allocated to the UK Infrastructure Bank. Just since we are talking about this, we have foreseen the National Investment Fund as focusing on manufacturing, so it will be complementary to the UK Infrastructure Bank, which focuses more on green infrastructure. So, and that would be the initial funding. And with this pot of money, let's say, the NIF will provide equity financing in various ways. So it could co-invest with private industrial partners to establish new subsidiaries, new companies, but the mechanism will be as follows. So the equity financing will be conditional upon the company, the private player, making capital expenditure in two ways: either increasing or creating manufacturing capacity in what we call green manufacturing sectors, and we're talking about wind manufacturing, solar manufacturing, heat pumps, electrolyzers, batteries, all these key net zero technologies. Or it could, and in this case, it would just buy an equity stake into an existing UK company. It could provide equity financing and so become a minority shareholder of a company which is supposed to use that funds to restructure existing manufacturing processes. So we're talking, for instance, about the NIF taking a stake in a major steel company in order for the company to set on a path to decarbonize, to introduce technologies such as direct reduce iron with the use of green hydrogen and things like that.
So thinking about it from a business perspective, a lot of people want to be in business because they don't want to be civil servants. So being a civil servant has a lot of restrictions to it that someone in private business doesn't have. So there's a lot of freedoms with being in a private business, but also there presents a lot of risk as well. So what you're talking about is a hybrid between something that is in between those two places. So I can't imagine that a business would take an equity stake with government supervision unless they weren't doing particularly well, or they were persuaded by the government that with a cash injection from the government, they could do much better. From a taxpayer's perspective, and I mean this very figuratively, because obviously we know that tax doesn't fundamentally fund spending, but from a public money perspective, and people that are concerned about the spending of public money, how would you then control the company so that it's working for the public good and not just the enrichment of a few people?
Thank you. That's a key question, actually, and it's it all boils down to the use of the equity instrument. So we've this is something that hasn't been explored much in the current reasoning about industrial policy, because if you consider like the US program, for instance, most of it, the Inflation Reduction Act, most of it is based on tax credits. So it's exactly as you were saying, no? So it's basically taxpayers' money given to companies to de-risk and to basically make those investments and then increase their profits. Simple as that. In this case, the aim would be to make these investments cost effective, so they will be made by the companies. Otherwise, they wouldn't be made. But at the same time, the public will have a say in the will be able to have a say in the governance of the company. So and in various forms. So it could be things like a simple supervision of how the investment project is going, labor conditions. But really, the idea behind it is to rediscover a little bit the role of the state as a shareholder. Really, I mean, Larry Elliott on The Guardian, when we launched the report, mentioned the National Enterprise Board. So this experiment by the Labour government in the 70s to introduce basically a state holding company to control part of the industrial economy of the UK. I mean, we're not, of course, suggesting anything like that, but basically the idea is that industrial policy it's not just about funding and handing out cash to companies, but it's also about coordination of industrial activities and management of conflicts. So there needs to be, in this new industrial policy scenario, a better relationship between the public and the private, we argue. So where the public has a say also in later stages of the investment process. So it's able to, but first of all, coordinate the various investments, so to maximize the impact of the policy, but at the same time to get a reward. And Mariana Mazzucato says normally, it's all about, if a state takes a risk, why shouldn't it take also get a reward when the reward materializes?
That's really interesting, and I think that's quite positive, but that's based on the assumption that shareholders actually have the ability to change the direction or the actual processes or procedures of an organization. And I think that needs to be called into question. If we have control because we have shares, then we need to justify, we have to demonstrate that control actually is meaningful. Do you think there's clear evidence that a small shareholding in these big businesses or medium-sized businesses would lead to a change in direction?
Well, I wouldn't say that there is evidence, but it's theoretically feasible, I think. In the report, we mentioned that when the state provides equity financing to the company, the company and the state and the NIF, they sign a kind of memorandum of understanding, an MOU, where it's specified what the company will do in the course of the years. So they are bound to an agreement, and also ideally the state would appoint a representative. Well, the NIF would appoint a representative in the board of the company, representing the interests of the public. But the point you raised is critical, I think, because, and I can say it from the experience. So I mean, I'm Italian, and my research has focused on Italian state-owned companies, which are quite important. Were quite important in the economic development, but are still quite important. Names like Enel, Eni, Leonardo, I mean, that these are all state-owned companies. So the Treasury appoints representatives in the board, but effectively these companies operate as private companies. Their main objective is to maximize profits, and of course they are systemic companies, so they have kind of national responsibilities, but I wouldn't say they are coordinated with an industrial policy perspective by the state.
There's no history of that specifically in the UK, though. That's an Italian model, and I think a European model. But when you look at the UK, is there any example of a company that works in any way like that? Because obviously you're grafting a kind of economic system onto a framework that's very different.
Absolutely, yeah. Well, the UK used to be a champion and an innovator in that sense, because the concept of public corporation, so a company, an entity which has a business-like nature but incorporates public policy objectives, was invented by codified at least by Herbert Morrison when he introduced the London Transport Authority, and then every nationalized industry in the UK took the form of the public corporation. So the electricity board, gas, British Telecom, and the National Enterprise Board was a bit different, because the National Enterprise Board grouped the nationalized industries and also had stakes into companies, like joint stock companies. So, for instance, the National Enterprise Board owned Rolls-Royce when Rolls-Royce was 100% owned by the government.
And just flag up to our listeners as well that, you know, the Italian economists really are a bunch of very clever people, and you know, people have to remember this is the home of the Medici. This is the home of, you know, central banking, and you know, so anyone who thinks that has any idea that the Italian economy is not successful are not looking at it. You know, it is not trying to compete with China, for example. It is selling really fantastic luxury goods which are sought from all over the world. So there's a lot to learn from the Italian economy. I guess it's this hybrid between public and private sector that I think is, in principle, it's a great idea. I think it's just going to be quite difficult to work. Certainly in the UK, we've seen in the past when the public sector has been perhaps too powerful, and this brought in the era of Thatcherism, where people, you know, didn't want the public sector to have so much power. We've gone to the completely opposite end of the scale now, where the private sector has also now way too much power. So there does have to be a middle way. I think what you're proposing is that middle way. I guess it's the machinations of it. How will it work, and what will be the problems that it will flag up? And I think, you know, you have some experience in Italy of this. So what have been the problems, and how have you solved them in the past there?
They haven't really been solved, because as in the UK case, in the 90s, major state-owned enterprises or public corporations were privatized. So they were either privatized entirely, or they were partly privatized and listed on a stock exchange. So they effectively became private companies. So there is no good lesson for you, unfortunately. I think, well, of course, we have to look into the past for some good examples, you know, of that, because we should remember that the so-called 30 Glorious, you know, where the period when the mixed economy was the model in effect. So economists like Andrew Schoenfield, when he wrote the book Modern Capitalism in 1964, he was talking about modern capitalism as the planning system with a lot of like administrative controls and state-owned companies and so on and so forth. We see that in the race to global competition in these technologies that we were talking about before, and the return of industrial policy, a trend to go back into that kind of model. But the problem is that 40 years of neoliberalism have deprived the national states, Western states, of the capacity to effectively run an economy, not like in a Soviet-style way, but to design and implement effective industrial policy. So that's why perhaps this is a cautious way of trying to make the public sector learn about how to regain these skills. And that's why also we argue that the NIF, for instance, that's key. When the NIF, if it comes about, hires its employees, it should look at people with the technological and engineering skills more than financial skills. That's because that has been a problem, for instance, in the case of the UK Infrastructure Bank, or in other cases. Like I think also in the case of the Scottish National Investment Bank, there's been a discussion about who should actually work there and what should be its expertise, because that changes the perspective. It changes how you run a public institution.
Yeah, it's looking at it as a bank and the money rather than what that money's supposed to do in the experience there. Well, it's been fascinating because we can clearly see this kind of different approach from what we've got at the moment, and I think that was really it was really interesting to hear that the UK developed these things initially, and this is a case of going back to where we were rather than completely creating something. I want to cover another topic. Our listeners will know that I'm a degrowther, and I looked at this proposal, and rather than calling it green growth, you've called it growing green, right? But I think it's pretty much the same thing. So I looked at this, and to read you a sentence here, it says, achieving green growth is one of the most important economic opportunities. If the UK gets it right, it can deliver a boost in its long-term economic growth, creating new highly skilled jobs. And this is something that I read in loads of policy papers and loads of government papers, this idea that we can grow the economy, that we can make the most of this climate crisis, and we can all be much happier. Now, I'm kind of going to say to you, I don't think that's possible, but the report does, and it says that the report is based on other research and other evidence. And there's this idea that we can all level up and that this climate crisis is a way to do it. So I don't believe that. Go on, try and persuade me that I'm wrong.
Well, if you consider growth in terms of use of resources and output, I would agree with you that we shouldn't be obsessing with growth. But if we consider growth in terms of value added, then in this case, and also if we look at growth across the income distribution as well, then we could argue that a green economy is an economy could be an economy with a higher value added, that doesn't deplete natural resources, that is more equitable, because you can argue that lots of both the manufacturing but also the deployment of green technologies it has a positive effect on the regional distribution of income and the dynamic also of income, because it's pretty much dependent on it's place-based essentially. So as opposed to the financial specialization sector, which tends to concentrate into a big city, or it's if you see it like that, I think you could agree with the main take of not the main take, but with the opening sentence of the report, which tries really to enter into the debate about growth, as you were mentioning at the beginning. So we're talking about a different growth, which doesn't imply, as I was saying, the depletion of natural resources and the production of output for the sake of production.
Going back to your earlier comment about combining the public sector, private sector, I've just recently been reading The Big Con from Mariana Mazzucato, and this infantilization of our public services that has happened through consultancy is really something that really deeply concerns me. I think it's insidious, and it's really problematic for our public services and to retain knowledge within our public. So what you're talking about as well is an injection of knowledge into our public services too, which I think is to be recommended.
I just have to take to defend what we did by saying that our proposal is basically restricted to a very specific, very narrow field of economic policy, so industrial policy targeted at green manufacturing, which of course cannot directly address what you've just mentioned. But I would argue that because this proposal is really about redistributing resources, I mean, industrial policies at the end of the day is also about structural change, but shifting resources and attention from one sector to another. And since we are also trying to propose something that could rebalance the economy, so to have a more territorially distributed growth, to rejuvenate certain areas, that might also contribute positively to what you were saying, because this area will become more appealing to people to move there, so to families to live, to nurses to move there, teachers to live in areas that are not deprived. Like it will in some way possibly stop the tendency to go and live in big urban centers, and go there because apparently livelihoods there are better, but then you realize that rent prices are too high, everything costs more, so it's really a vicious loop. So the rebalancing of the economy is key, and I think it will have positive spillover effects also in that respect.
Now, we're going to ask you a couple of Scotland-specific questions, okay? And because we're getting on so well, I'm going to frame these very directly to you, okay? So at the start, tell me if I'm wrong, but at the start you said that it would have an initial capital endowment from the Treasury. And when I read the report, I think it suggested that this money should effectively come from fossil fuels. So it should come from the taxation of fossil fuels. So I was looking at this from a Scotland's perspective and thinking, okay, so all of Scotland's resources and revenue is funding this British National Investment Fund. What would be your response to that, Simone?
Yeah, you're right. No, well, we say the initial capitalization should come from the Treasury, and then we suggest that there should be an automatic mechanism that recapitalizes the fund, because if the fund aims at industrial policy objectives, it won't be able to obtain financial returns for its recapitalization, especially in the first, particularly in the first few years. And even if the companies it invest into become economically viable, we argue that the NIF should actually push for the retainment and reinvestment of the economic surplus. So at some point, then the NIF will kind of run out of money. So we suggested that one way to recapitalize it would be to well, first of all, to change the fiscal regime in the oil and gas, in the North Sea oil and gas sector, because it's if you compare it to other North Sea countries, it's quite dysfunctional, I would say, because of the incredible amount of tax loopholes and tax rebates due to, for capital allowances for new investment, transfers for decommissionings. Many years, the British state gives more money to the oil and gas companies that actually receives back.
It's shocking, isn't it? And that's worth highlighting, isn't it? That this massive industry very often is subsidized by the state rather than earning revenue from the state.
Yes. So in the past, we calculated that in the past 6 years, I hope I'm okay, I'm right with this because I did it quite recently, but basically on average, the tax receipts from North Sea oil and gas was around £800 million, and it would have been 3 billion without the tax credits and the capital allowances. So it would be 4 times higher on average per year. So it's basically more than 2 billion per year. So it's quite a significant amount of money. With respect to the Scottish question, I thought that the revenues would be of course, most of the North Sea concerns Scotland, but I thought that revenues were actually received by the British Treasury. So I'm not aware about how much it's then redistributed back into the Scottish government.
Yeah. No, you're correct. It is the resources of Scotland that go straight to the Treasury, and that's my point.
Right.
You know, it's not a processing how much does Scotland get. It's a clear understanding that this fund would be capitalised by the resources coming from Scotland. And with the Scottish perspective, you can say, so Scotland's resources are funding this British National Investment Fund. Well, we're only going to see, let's say, at best 10% of the funding, but 80% of that funding is coming from Scotland. So there is definitely a Scottish aspect here that wasn't covered in the report, and that's why I wanted to ask you that question quite directly.
That's a really fair question. We haven't thought. I mean, we considered, of course, that the NIF would invest with the prevalence in outside the typical Southeast London area, but we hadn't actually thought about that in case it was to be recapitalized through that mechanism, then there would be a transfer, a net transfer from Scottish resources to the rest of the UK. So in that case, I would say that there should be either a compensation mechanism of some sort, or that there an extra amount of resources that the NIF invests should go to Scotland.
We'll look forward to that coming in your addendum then. So you're talking about the recapitalisation coming from effectively the surplus of these businesses or from the taxation of fossil fuels. But obviously the UK government doesn't need that revenue to be able to capitalise this fund. It could just capitalise this fund through government spending. It could just create this. Isn't that a better way of continuing? And then they'll always have the amount that they need to spend, because if it's recapitalised through investment, then at some point it might not have enough money to actually deliver on objectives. So is setting it up as this kind of business just the wrong way to go about it if we want to actually be effective in terms of what the fund's doing to support?
I agree with you in theory, let's say. In practice, making that argument would have meant entering into another debate about fiscal policy, and when you propose something new that it has a specific target and focus, you want it to be bulletproof. So we thought that the fund could achieve the same industrial policy result even under a mainstream fiscal policy approach, because we just wanted to focus on the industrial policy objective, wanted to be well structured with the governance that would allow the government to be on the guiding seat in this case, and not just captured by private interests and private financial interests especially. So the answer would be we deliberately decided not to address the issue, which I think personally, as an economist, it's very relevant, and I agree with what you said on that.
I've got one other Scotland specific question, because there's certainly issues around the Scottish National Investment Bank, but you did mention it just a couple of times in the report, and it's up and running. It's got a very, very strong green framework. It's only investing in certain, these types of areas that you're talking for this NIF. And what seemed like a logical thing for me would be that you would say, well, the NIF is going to have this revenue and it's going to give it to the the Scottish National Investment Bank, to run for Scotland. But it didn't seem like that was the case. It seemed like this report said, oh no, we'll just take what's an independent, well-established, okay, there are issues with it, but we'll take this into the National Investment Fund and we'll just allocate that on a British basis. So again, I had a little bit of concern from Scotland. I didn't think we were given enough consideration on what's happening already. What would be your response to that one?
Well, you're right. I mean, we haven't considered that, but at some point we say that the NIF should invest alongside existing public financing institutions, including the Scottish National Investment Bank. So you could, we didn't venture into how that could take place, but you could conceive joint investment, which is made by the NIF, the Scottish National Investment Bank, if it decides to take an equity stake into the new venture, and therefore follow in a way the NIF governance model. In that case, the Scottish National Investment Bank will be able to appoint a representative in the board and to make its voice heard in the governance of the company. So in that case, it would be like a Scottish version of our
another addendum then, because there was a very different approach you could have taken here, and this could have been a set of regional investment funds rather than this national investment fund. And again, I'm from our kind of four nation perspective, in Scotland being a separate country. Again, I was hoping that I would have seen a proposal that said, actually, this is an opportunity for us to do that on a much a kind of four nation. But again, it seemed to be this idea of bringing everything into the centre and then pushing it out. Again, that's my final kind of controversial question to you. What would be your response to that one?
No, I think in honesty, the report stresses a lot the regional element, not at the nation level, but perhaps even if in the governance of the NIF we foresee that there will be representatives from nations, regions, and cities of the UK. So in the stakeholders councils, there will be representatives from these territorial levels. We conceive the NIF as a national institution with regional branches at the ITL1 level. So you'll have Scotland, and then Wales, and then Northern Ireland, and then the other ITL regions of England. But the reason why we didn't propose regional NIF, so regional NIFs, just regional NIFs, is that the way in which the fund will work is that it will, in a way, be in a bargain. We'll be bargaining. We'll be discussing with sometimes with the foreign industrial players which have the technologies to invest. And so we thought that by being a nationwide, like a UK British nationwide fund, it will have more power to negotiate. But then, of course, it will lead to a lot of autonomy. It will leave a lot of autonomy to the regional branches for the implementation of the projects, and the representatives in the boards of the companies will come from the regional branches.
Yeah, I guess for us, both me and William would like to see our country become independent again. And we look on this with some degree of speculation, where the idea is sound in and of itself, but the execution we're less optimistic about. That's probably realistic from our point of view.
So yeah, that's been really fascinating, and thank you so much for joining us.
For the discussion. Very interesting.
Thank you. Thank you.
Well, thanks very much for joining us on that session and for all the comments. We kind of said we covered a lot in that interview, and one thing I wanted to highlight before we headed off was that we discussed with IPPR very briefly that if they wanted a chance of this proposal to be accepted, it kind of had to sit in or fit in with the current kind of economic paradigm. And we're actually going to discuss the neoliberal economic paradigm in some detail tomorrow in our article for The National. So I encourage you to look for that one. I think it gives a lot of extra support for the type of conversation that we had there. And just to kind of say that it's really clear that this proposal is a neoliberal one. And although it comes from an organisation or a think tank that's fairly on the left, it's still trying to fit into this neoliberal paradigm. And I think this is what we've really, really got to try and break away from, is to start having solutions that actually don't just take as read the problems that we have created by this economic paradigm. And then I just kind of wanted to very quickly highlight that, firstly, the fund relies on the direct support of the government, which for me is the kind of defining feature of neoliberalism. It needs the government to create this market and to oversee its governance. It is looking at public risk, public money being spent, but private profit or private gain. And that's another thing that's really neoliberal. It's market-led, although not as much as maybe another solution could be, but I think that's really just fraying around the edges rather than anything substantial. It fits into the current structure and the governance and this idea that shareholders are the best institution for managing companies and for overseeing its governance. And that is very neoliberal. I think there's huge issues with that when you actually get into the weeds of how companies and how shareholders are engaging and being involved in the governance of these types of organizations. So I think that's a really important point. Fundamentally, this paradigm and this proposal considers the efficient allocation of capital. That's what it's looking at. How can we allocate this capital most efficiently? Now, they're not looking at how we can allocate this capital most fairly, or I think even more importantly, how effectively. Because if you were to design a national or regional green industry policy, you would be thinking about how can we do this as quickly and as effectively as possible so that we can start to fight the climate crisis. But that's not the priority. The priority is how can we efficiently manage this or allocate this capital, not effective, but efficiency. And also, I think it'd be looking at what's the most just way to deliver this strategy. Where do we put this money? Maybe it doesn't bring back as much capital as or much profit as putting a business somewhere else. But what's the most just way of delivering this? These are the things that are not considered within this neoliberal paradigm. And as I said, we cover that in a lot more detail in our article in The National tomorrow. Well, that's all for us tonight, apart from to say in 2 weeks' time, we'll be back and we're going to look at degrowth in a lot of detail. And we're going to try and look at this idea of degrowth from a Scottish perspective. So thanks so much for joining us tonight. Please do drop any comments, any thoughts beneath the video when we're finished, and do like and share. So we'll see you hopefully in a couple of weeks' time. Bye for now.